Most business owners are leaving thousands of dollars on the table every single year. Not because they're doing anything wrong, but nobody ever told them what they were actually allowed to deduct. Today, I'm walking you through the top deductions every business owners need to know. And if you're already working with a tax professional and these haven't come up in conversation, that's a sign that you need a different conversation. Hi, I'm Sonya Moreno, tax strategist and founder of Sonya Moreno CPA LLC. I work with business owners to do one thing: keep more of what they earned. Not reactive tax prep, proactive tax planning. There's a big difference, and by the end of this video, you'll understand exactly why that matters. So let's get into it. If you have a dedicated space in your home that you use regularly and exclusively for your business, you can deduct a portion of your rent or the mortgage, your utilities, internet, and even repairs. The key word here is exclusively. So that spare bedroom where you also have a guest bed, it doesn't qualify. But a room that functions solely as your office, absolutely. There are two methods for calculating this: the simplified method and the regular method. The regular method does take a bit more documentation, but it often produces a larger deduction. This is something that your tax strategist should be running the numbers on for you every single year. If you use your personal vehicle for business purposes, you have two options: the standard mileage rate or actual expenses. The IRS standard mileage rate changes annually, so you want to make sure you stay current. But the bigger issue I see is that business owners aren't tracking their mileage consistently. No log, no deduction. It's that simple. I recommend a mileage tracking app. Make it automatic. Every business trip, client meeting, supply run, log it. Over the course of a year, that adds up to a serious deduction. And if you own your own vehicle through your business entity, the conversation gets even more interesting. This one is personal to me because it ties directly into legacy building. Business owners can deduct contributions to their own retirement accounts, and the limits are significantly higher than what a W-2 employee can contribute. A SEP IRA, for example, allows contributions up to 25% of net self-employment income, up to a very generous annual cap. A solo 401k can go even higher depending on your structure. Here's what I want you to hear. You are building wealth and reducing your taxable income at the same time. That's a double win. And yet so many business owners are not maximizing this out because no one walked them through the tax strategy. This is the kind of planning conversation that changes trajectories. Courses, certifications, books, industry conferences, coaching, all of it can be deductible if it relates to your current business. It has to relate to your current trade or business, not a new one you're trying to get into. So those marketing courses you bought to grow your client base, deductible. The conference you attended in your industry, it's deductible. The coach that you hired to scale your operations, it's deductible. So keep your receipts and keep notes on how each expense connects to your business, because I can't stress this enough. Documentation is everything. If you are self-employed and not eligible for coverage through a spouse's employer plan, you may be able to deduct 100% of your health insurance premiums for yourself, your spouse, and your dependents. This is an above-the-line deduction, meaning you don't have to itemize to claim it. For business owners who are paying their own premiums, this is often one of the largest single deductions available, and it's frequently missed. Again, this is why working with someone who is looking at your full financial picture all year round, it matters. A tax preparer who only sees you in April has no idea what you've been paying all year. When you purchase equipment, furniture, software, or other business assets, you don't always have to depreciate them slowly over multiple years. Section 179 allows you to deduct the full cost of qualifying assets in the year that you place them in service. Bonus depreciation works similarly and has been a powerful tool for business owners making larger purchases. The rules here have been shifting, so this is one area where you absolutely want current guidance from a tax professional. What I want you to walk away with is this. Major business purchases can be strategic tax moves. The timing of when you buy matters. So that new laptop, that piece of equipment, or even that software subscription, these are not just expenses, they are planning tax opportunities. Here's the reality. Deductions don't mean anything if you don't know about them before tax time. The goal of tax planning is to make these decisions throughout the year, not scramble in April trying to remember what you spent money on. If you are a business owner and you are not currently working with someone who is proactively identifying deductions and building a tax strategy around your goals, I want to invite you to change that. I'm Sonya Moreno, CPA. Download my free guide in the description below. Tax season comes every year, right? The question is whether you are walking in prepared or walking in hoping for the best. I help business owners walk in prepared. I'll see you in the next one.